Welcome to Markets Now. I'm Michelle Rook with Mark Schultz, Northstar Commodity. Just about everything's higher except for the cattle complex this morning. And Mark, let's start off talking about soybeans. We've had a chart breakout here kind of pushed by China business, but also South American weather is an issue too, isn't it?
Yeah, the South American weather has started to get into a pattern here it's having a difficult time breaking, and that weather pattern has been a warmer, drier trend in the central and northern part of Brazil, which has kind of slowed down the soybean planting. I think Mato Grosso did move up to at least to 83% planted on the beans in Mato Grosso compared to 93% a year ago. This far southern part of Brazil has been on the excessively wet side. I wouldn't say there's any problems with the wet yet in the south. It will, of course, be a little bit concerning if it continues on. Obviously, in the big picture, soybeans don't like a lot of wet feed. So that might create some concerns further down with disease issues. But for right now, they're fine. But the north is what you got to watch right now on here. There's also some chatter that there may be some replant of soybeans simply from the dry side. And the forecast, at least coming into today, from what it was on Friday, it looks warmer, drier in central northern Brazil today than it did on Friday.
Yeah. Meal is correcting today, but has had a good run while bean oil is back up higher. Is that, working into what's going on here today as well?
Yeah, I think the oil has had quite the sell-off here since the August 21st. We've dropped significantly. And of course, at that time, we also had the funds long significantly in the bean oil. We have now come all the way back down to what I would view as it's a pretty solid support on the bean oil, and the fact that the funds are now out of all their long positions and actually to the short side of the bean oil. So I think there's at least a little bit of validity that the soybean oil may start to make a little bit more of a move to the upside. Now, with that said, soybean meal went to new contract highs, and there's no denying the export demand for meal has been very, very good.
Right.
And that has been going. So I watch the meal. If it does indeed now take out the previous or the highs that we currently have posted, that, of course, would still be a very friendly chart signal, and that would then, of course, kick the bean market into a much more of a bull market. But for right now, we think the soybeans, January beans, going to have some tough resistance right up at around 1375 to 1380.
Right. And we're under that level here as we speak. So we'll see if we can get back up through those levels. Soybeans kind of pulling the corn along. It's kind of a reluctant follower, it looks like. But we did have that reversal on Friday. So can we build on it?
Well, I like the technical reversal. And of course, we went down, and what makes that technical reversal a little bit more interesting is the fact that the nearby futures went down and tested the previous lows. So it sets up and also looks like a possible double bottom in here. Now, we're also getting geared up that on Thursday, the USDA will come out with their supply demand report. And of course, the trade is anticipating that the corn yield will likely go up slightly, and we'll likely see a carryout increase, not decrease. So that's just one to watch. The funds are carrying a huge short position in the corn market. So again, we're going to have to start seeing more the bearish news continue on. They've been right so far. We're going to have to see the bearish news continue, or else we're likely to see a market turn around. So that technical action certainly does look a little bit intriguing on the corn market.
All right, you mentioned the WASDE out on Thursday and kind of expectations here. Yield really is the big one for both corn and soybeans, though, right?
I do think so, and I don't expect it to be a big change. I'm leaning towards that the corn yield, it may come down, but I don't have a lot of faith in that. I'm just hoping it doesn't go up a bushel and a half or more. That would be, of course, the short-term negative tone to the bean market, or for the corn market. The soybeans, on the other hand, we're pretty confident that we're likely to see a lower bean yield in this upcoming report.
Will we see demand adjustments, Mark?
I think if we have demand adjustments, I don't think it's going to be to the friendly side. It might be a little bit more to the negative side. In the big picture, though, that's looking at things short term. Longer term is where I still think that the demand, and this is where the South American weather and production becomes more important. If the weather does not improve or straighten out, then the demand for U.S. corn and soybeans is going to be far better in the last half of 2024 than it was in 2023. So the demand picture will be better later in 24 than it will be than it was last year.
So we talked about South American weather, but is it too early for USDA to make adjustments downward to that crop in this report?
Making any type of an adjustment that is a big market mover, I would say, is probably pretty slim. I don't think they'll make any significant changes yet. They'll probably likely take their time, because the most critical time for the beans usually starts getting past the 15th, 20th of November on into about the probably even the first 15 days of January is when that crop needs more moisture. So also keep that in mind too, is that the moisture requirement gets greater as we start unfolding. We get in the last half of November into December. So that's where things become far more critical than they are right now.
Yeah, and usually USD is a bit conservative here this early on. Wheat market, just a follower of corn and soybeans, or is that the lower dollar? Because it certainly wasn't export inspections.
Well, it's not exports, and it's probably not going to be exports. And
No.
the battle with the wheat is that it looks like the weather is at least improved for Europe, Ukraine, and Russia. So I think you've got a pretty good establishment of the winter wheat over there. The rains appear to have came just in time to help out some of the Argentina. Now, granted, it's still going to come down on their wheat production, but it looks like it's not going to get any worse than what it was 2 weeks ago. Australia probably still in some decline there, but again, we're talking maybe 2 to 3 million metric tons, and that'd be about it. And then here in the U.S., of course, the plantings done quite well, and crop ratings on wheat are far better this year than they were last year. So we're going to go into dormancy in very good shape with the wheat crop.
Yeah. So I mentioned cattle lower. We had a gap lower opening there, so the charts look pretty ugly. There seemed to be some disappointment about this steady cash trade in the South on Friday that came out really late. But are you worried about, where we're at here with this chart picture?
Yes, in a way I am. I was hoping we would still be able to put on another $2 from where we were on the close on Friday. That hasn't happened. And what really is a little more, even more short-term concerning, is the fact that the beef cutout has fallen this last week to the tune of about $5 off the choice cutout. And we're at a time period when we should see a lot of this buying taking place for the holiday periods going on not only here in the U.S., but also Asian market customers typically are buying U.S. beef at this time. Well, we've had 2 good weeks in a row of export sales on beef, but we've dug ourselves a hole here, and that is a problem. I think the other big thing we have to watch, and so far it has not happened, but I am getting a little bit more concerned that if in this last week when we did not sell as many cattle for the week as I was hoping for, one has to be quite concerned that we don't start backing cattle up. We're putting more cattle in from the pastures into the feed yards last month, and we're likely to do the same again this month. And that is going to be a concern. And the last thing we want to start seeing is where the cattle weights start going up over a year ago, because I think we've already lost some on the domestic demand.
Yeah, well, choice select spread is pretty wide, so it looks like we're still pretty current, but we'll kind of watch that, obviously. And to your point, choice boxes today at noon just above 301, and 300's been kind of the line in the sand there, hasn't it?
It sure has. And if we start trading below that, and what it does is when you have the box beef, even at its current level, the packer margins are roughly right now with cash where it was on Friday, sitting between probably $75 to $85 per head in the red. So when you have that type of alignment, you sit back and you look and go, well, what's going to make the packer be aggressive with this cash bid? And obviously, the fact that the farmer feed yards didn't be aggressive on the sales, they're trying to dig their heels in, thinking you need to pay me more. And I think we better be careful with this one.
Hogs back up after a lower day Friday, so maybe a little corrective buying. But have you been surprised, Mark, with we've had over a 50% retracement here? Have you been surprised just because of the numbers that we have that should be a big headwind for this market?
We have the numbers are a problem for the pork, and that's really, quite frankly, about the only problem you have for the pork. Everything else looks pretty good on here. No, I think we've got domestic demand has improved some for pork demand. I think the price has certainly reflected that with high-priced beef and pork where it's at. It has come back to improve. Our export sales on a monthly basis have been better every month this year. So nothing is changing on that front. Granted, we got the numbers coming in, But when you look at total pork in the coolers, where I think we're 14% below a year ago, and when you look at the primal cuts of where we're at, we're down significantly in bellies for a year ago, 19% less bellies in storage than we had last year at this time, 40% less on spare ribs in here. And the hams are also down about 6 to 8% less. So if the primal cuts with that, I would suspect that the primal cuts or the pork cutout will not go lower than it did last year, which was around 76 to 78 bucks. So I think that holds up. And if that holds true, I think the rest will be just fine.
All right. Well, that's some good news, at least for a change for hogs. Thanks for joining us, Mark Schultz, Northstar Commodity. That is Markets Now.